As we are in the weekend, the U.S. stock markets are closed. The last trading session for Walmart Inc., ticker WMT, concluded on Friday, November 14, 2025. The stock closed at $102.48 per share, registering a very slight decline of 0.060 or 0.059%. Now, on the surface, that movement is completely flat, basically background noise, but that flatline close masks an absolute bombshell that landed on Friday, a development that has completely rewritten the narrative for this $817 billion retail giant. The expectation for Walmart has long been one of stability, a fortress of consumer defense led by one of the most respected CEOs in the business. The reality, delivered just yesterday, is that this fortress is undergoing a change of command at the highest possible level. CEO Doug McMillon, the man credited with saving Walmart from the Amazon onslaught and transforming it into an omni-channel powerhouse, is retiring. This isn't a distant plan. He's stepping down effective January 31, 2026. The market's fractional dip wasn't the real reaction. The stock actually traded down more significantly earlier in the session on the news before recovering. The real story here is that the market is now grappling with what Walmart looks like without the leader who quadrupled its stock price and consistently outmaneuvered competitors. This is the kind of news that makes long-term holders using Fidelity wealth management for their Fidelity IRAs pick up the phone, and it causes active traders on the Robinhood app to pause. The common belief, the narrative that everyone from Wall Street to Main Street had bought into, was that Doug McMillon was Walmart's indispensable asset. He took over in 2014 when the company looked like a deer in the headlights, watching Amazon eat its lunch. He's the one who forced through the massive, expensive, and painful pivot to e-commerce. He's the one who leveraged Walmart's 4,600-plus U.S. stores into a logistics network for grocery pickup that Amazon still can't effectively counter. Under his leadership, Walmart stock hasn't just beaten the S&P 500, it has, over the last 5 years, dramatically outperformed Amazon's own stock. That's the expectation. McMillon is the infallible leader. So, the market should be in free fall, right? The reality is much more nuanced. The stock is nervous, but it didn't collapse. Why? Because the succession plan is the most Walmart thing imaginable. McMillon is being replaced by John Furner, the current CEO of Walmart U.S., and a man who has been with the company for over 30 years, having famously started as an hourly associate. This isn't an outsider coming in to shake things up. It's the ultimate insider, the man who has been running the company's largest and most important segment. The tension, then, is between the market's fear of losing a visionary, McMillon, and the company's signal of pure continuity, Furner. But this leadership change, as massive as it is, doesn't happen in a vacuum. It lands at a moment of extreme fragility for the stock and the consumer. Let's look at the recent trading. That $102.48 closing price isn't just a random number. The stock is actually down more than 7% from its all-time record high of $109.03, which it hit just 1 month ago on October 15th. This means the stock was already showing significant weakness before this announcement. Traders have been taking profits, worried about the same things we're all seeing: persistent food inflation, new tariffs threatening to raise prices on holiday goods, and clear signs of consumer stress. While Walmart has been a beneficiary of this environment, capturing higher-income households, those earning over $100,000 who are trading down to save on groceries, the question is how long that tailwind can last. This isn't a high-flying tech name like Tesla stock or Nvidia stock, which trade on future projections. This is a company that trades on the immediate health of the American consumer, and that health is uncertain. The pressure is immense, and now it all falls on John Furner. This uncertainty is perfectly reflected in what the smart money is doing. If you're managing your own individual brokerage account, maybe through Fidelity or Schwab Intelligent Portfolios, you're trying to figure out what the big funds are doing. The latest institutional filings from September 30th, before this CEO news, show a market completely divided on Walmart. On one side, you have FMRL, the parent of Fidelity Investments, which absolutely slashed its position, dumping over 9.6 million shares, an 18.9% reduction in its massive stake. That's a huge vote of no confidence. But in the exact same period, JPMorgan Chase & Co. did the complete opposite, adding 18.3 million shares, a massive increase of over 18.6%. This is a fundamental disagreement between two of the world's largest financial institutions. One sees a stock at its peak, facing margin pressure and a tapped-out consumer. The other sees a value-creating machine with a growing high-margin ad business and a dominant e-commerce platform. This isn't a clear signal. It's a battleground. This is the kind of data that active traders using the advanced tools on the Interactive Brokers trading platform live for, while a passive investor might just stick with their Fidelity mutual funds and hope for the best. The timing of this succession is what makes it so critical. Walmart is scheduled to report its third quarter earnings in just 6 days, on Thursday, November 20th, 2025. That call, which was supposed to be a standard update on holiday inventory and grocery margins, has now become a high-stakes introduction. The market will be hanging on John Furner's every word. It won't just be about the numbers. It'll be about his tone, his strategy, and his ability to project the same unshakable confidence that McMillon did. Analysts, like those at UBS, are still bullish. They just reiterated their buy rating with a $122 price target, saying they expect a clean print from the earnings. But that call was before the CEO news. Now all bets are off. This is a make-or-break moment for Furner right out of the gate. For anyone looking for investment help or doing their own self-investing, this earnings call is now the single most important catalyst for the stock in the next year. To understand the stakes, we have to look at what exactly Furner is inheriting. This isn't just a chain of big box stores. This is a sophisticated tech-powered omni-channel machine. McMillon's true legacy is the digital transformation. In the most recent quarter, Walmart's global e-commerce sales were up a staggering 27%. That's not a typo. Even more impressive, its global advertising business, a high-margin segment that leverages its website traffic, was up 28%. This is the Amazon part of Walmart's business, and it's on fire. It's why many Fidelity ETFs that focus on consumer staples have such a heavy WMT weighting. This digital growth is anchored by its utter dominance in online grocery. In 2025, Walmart commands an estimated 32% of the entire U.S. online grocery market, while Amazon lags significantly at around 22.6%. This was the genius of McMillon's strategy, using the stores for pickup, and its membership program, Walmart Plus, is a direct shot at Prime, offering similar perks for $98 a year versus Prime's $139. This is the engine Furner has to keep running at full speed. He's not just a store manager. He's now the head of a massive e-commerce and media company that also sells groceries. This all brings us back to that earnings call on November 20th. The numbers will matter, but the guidance and the transition will matter more. Comment below. Do you think John Furner, as an insider, is the right choice to continue Walmart's digital fight against Amazon, or did they need an outside tech-focused CEO? Your answer gets to the heart of the current investment debate. Are you making a trade on your SoFi investing account, or are you building a long-term position? The reaction to this news shows how differently people approach online investing. Some are panic selling SoFi stocks and moving to cash. Others, perhaps using Robinhood stock trading for its simplicity, see this dip as a classic buy the dip opportunity, grabbing Robinhood fractional shares on a blue chip name. More sophisticated investors on interactive brokers are likely looking at options contracts, betting on the volatility around next week's earnings. This is where investing sites and quality research become so important, whether it's through Fidelity brokerage reports or an intelligent portfolios analysis. So let's look at the path forward. The bull case is clear. Furner is the continuity candidate. He's been running the U.S. operations, the company's crown jewel. He'll step in, the earnings will be clean, as UBS hopes, and the machine will keep humming. The high-income shoppers will stick around, the ad business will grow, and the stock